How bank and business loans work. Most people think a bank loan is simple. You ask for money, they give it, and you just pay it back with a little extra. But the truth runs deeper. A loan has four main parts. Principal, the amount you borrow. Interest, the rent the bank charges for using their money. Term, how long you have to pay it back. Collateral, what they can take if you don't pay. On top of that is your creditworthiness, your credit score, your income, your debt load, and, if it's a business loan, your business plan. Banks structure loans through amortization. That means in the early years, most of your payments go to interest, not principal. You feel like you're paying, but the balance barely moves. This is how banks keep you locked in. The problems start here. Traditional banks favor people who already have assets. They often turn away new entrepreneurs and small businesses. Many business loans require a personal guarantee. So even if your company fails, the bank can still come after your house, your car, your savings. And the longer the loan, the more interest they make. That affordable 10-year loan can drain you dry. A $50,000 loan at 8% interest over 10 years turns into over $22,000 in extra payments. And beware of predatory lenders. Some offer quick cash advances for small businesses, but the interest is sky high and the daily payments can sink you fast. But there are solutions. For individuals, credit unions often offer lower rates and friendlier terms than the big banks. Secured loans and credit cards help you build your score without crazy interest. Debt consolidation can roll multiple payments into one at a lower rate. And many nonprofits and libraries offer free financial literacy classes to teach you how to manage debt. For small businesses, the U.S. Small Business Administration, SBA, backs loans that banks otherwise wouldn't give. The SBA 7A loan is flexible with lower rates and longer terms. The SBA microloan offers up to $50,000, perfect for startups. The SBA 504 loan helps you buy real estate or equipment with low fixed interest. There are also Community Development Financial Institutions, CDFIs. These are nonprofit lenders focused on underserved communities. They often provide easier approval, more flexible terms, and free business coaching. And if you're really starting small, Kiva offers 0% interest microloans up to $15,000, crowdfunded by everyday people with no hidden fees. Grants are another path. Unlike loans, grants don't have to be repaid. You can find them on grants.gov or through city and state programs. Many are targeted for women, minority, or veteran-owned businesses, or for specific industries. Crowdfunding platforms like Kickstarter and Indiegogo let you raise money from supporters before you even launch. Here are some real resources you can use. SBA.gov, official small business loans and grants. CDFI Locator, find community lenders. Kiva.org, apply for 0% interest loans. Grants.gov, search federal grants. NYC Small Business Services, free help for entrepreneurs in New York. Credit Union Search, find credit unions near you. The takeaway, loans aren't free money. They're contracts built to favor the lender. But if you know the rules of the game and use the right resources, you can get the funding you need without being swallowed by debt. You don't have to play only the bank's game. You can play smarter.